Welcome everybody to this presentation of the Q4 and full year 2003 results of Hafnia. Welcome to you, Michael Skov, the CEO. My name is Ture Østergaard. I'm with HC Andersen Capital and I'll be the moderator today. Please put any questions you might have in the chat and I'll ask them accordingly. We will spend approximately 20 minutes on the presentation and then of course go into all the questions there will be. So welcome, Michael, and congratulations on the best ever result, I guess.
Yes, thank you very much for that. Absolutely. So, yes,
so perhaps just a brief introduction to Hafnia, and then we'll go into the Q4 numbers, please. Over to you.
Thank you. So, for those that are not too familiar with Hafnia, let me just start by saying that Hafnia is all about transportation of refined oil products. So we are employing product tankers that are basically transporting anything from gasoline, diesel oil, jet fuel, etc. Anything that comes out of a refinery. As you can see here on the top left, for 2023, we have been financially controlling a total of 130 vessels, which is a combination of owned vessels and vessels we have leased from other partners. We had, by the end of 2023, a net asset value of $3.9 billion. We have a modern fleet, which is below left, of 8.3 years. And just to put that in context, you need to see the 8.3 years versus the average product tanker fleet worldwide from all owners of being between 12 and 13 years old. So a very modern fleet, which is important for a lot of different reasons. But one important one is that it's with a much more improved environmental footprint than older ships. So that's one of the key elements of having a modern fleet. We are listed on the Oslo Stock Exchange, but we have also announced that we will shortly be listed on the New York Stock Exchange as well. And that will be in a very short while, already next month. So after that, we will have two dual listings. So we're not moving away from Oslo. We're just simply having two dual listings in order to attract more investors and hopefully improve the liquidity and the pricing of the Hafnia share. Finally, on the right side, just five quick bullets that we'd like to touch upon. One is the active management. Hafnia is a very young company. We were founded in 2011, and already here, 12 years later, we are the largest global ship owner and operator of product tankers in the world. And part of that is due to the active management strategy that we've had, which means that we are actively out all the time to find growth opportunities, to continue to look at areas where we can improve earning streams for the company. So this goes from having added 44 vessels to the fleet back in 2021 to 2022, but also having increased the fee generating structure, which is basically based on us managing other people's ships against fees. And that in itself for the entire 2023 generated revenue for the shareholders of around $38 million. So all in all, I think, a company which has a strong focus on ESG and also, as I mentioned earlier, strong focus on shareholder returns. At the moment, we're basically focusing on returning capital to shareholders and not looking to deploy capital to buy more vessels.
With that introduction, I think we should go into some of the key updates you might want to touch upon.
Yeah. So here on this slide number 6, you're seeing some of the initiatives that we have been looking at in the past year. We have expanded one of the pools that we're operating, the Hafnia Panamax pool, which is basically a partnership with Mercuria, which is one of the big oil traders on a global basis. So together we formed this pool to employ Panamax vessels that primarily will be employed in trading and shipping fuel oil, with a focus most likely on the Western Hemisphere and the Caribbean Sea. And again, just an expansion part where we are adding to the scale of ships that we have under the Hafnia umbrella, but at the same time also adding the amount of information we get of how to spread the tonnage out and how to employ it most profitable on a global basis. When it comes to the future, and particularly the fact that the energy complex eventually will be changing, Hafnia has already now placed a few small investments in production of synthetic hydrocarbon fuels, amongst others. This is the mid part of the slide. So we have together with a few other partners in a project called Big Hill, focused on the production of ammonia and methanol and sustainable aviation fuel. And for Hafnia going forward, the whole idea about doing this is that we will be responsible for the transportation requirements of this. So we're basically trying to find ways where we can, for very small investments, make ourselves available for more transportation of renewable in the future. So in other words, we are planting the seeds for a renewable path for Hafnia going forward. And those are the kind of projects that we'll continue to look at, where there are small investments, but it will give us an exclusivity right to arrange the transportation of sustainable fuels once the production has been finished in 3, 4, 5, 6, 7 years' time. On the sustainable biofuel bunkering, it just shows the same thing again, that we are trying to focus a lot on how can we improve on the existing assets and their environmental footprint. And one of them is to have drop-in of biofuel in the traditional fuel, which can get you savings of up to 20 and 30% of your emissions. So just another example of some of these initiatives that we're trying to push hard for on the ESG side and the environmental side.
Perfect, Michael. And perhaps we can just go into the Q4 numbers then, if you want to share, please.
Yeah. So again, I mean, the fourth quarter was a very strong quarter for Hafnia. It was actually a quarter that wasn't probably as strong as we and others would have expected, because the winter market came a bit late. So what we have actually seen is that despite the fact that the fourth quarter did improve quite a lot, now we're obviously not unhappy with the results that we are seeing here of 176.4 million. But the reality is that a lot of the activity that we expected in the fourth quarter, we're actually seeing now in the first quarter. So this is also the reason why the expectations for Q1 that we have already advised about today are super strong. And we are at the moment in a very strong freight market, reflecting both a strong winter market, but of course also extra ton mile coming out of some of the current situations that I guess we'll be talking about in a minute as well.
Yes, and this gives me a reason to ask to the dividend, because that's always a key thing that you want to discuss and share. I guess you get 2.57 Norwegian kroner on the 19th of March. Perhaps just it's a reminder of why is it arrived at that number?
So basically, what we have done with our dividend policy, and we've been very consistent in this from the beginning that we advised about our policy, is that we will continue to increase the dividend as we are reducing the net loan to value, i.e. reducing our debt technically on the assets. And at the moment, we're paying out 70% because we are between 30 and 20% of net loan to value, around 26% at the moment. The moment that we break 20% net loan to value, we will increase the dividend from 70% to 80%. And just to be clear, on dividend in general, so at the moment in Hafnia, our strong view is to return capital to shareholders. So we don't have any intentions at any point to be sitting with excess cash at any point in time. So right now, this is the focus. When we will reach the 20% net LTV, of course, depends on market earnings, but also on uplift in asset prices. And fine, if things go very fast both ways, then this could happen very shortly. And if not, it could be sometime during the year. But just to be clear, there's no intention at any point to be sitting on excess cash in Hafnia. So whatever excess cash at that point will definitely be discussed about increasing dividends back to shareholders.
Good. Is there anything related to the full year 2023 you want to share that comes out of the ordinary here? I guess we just discussed the LTVs.
So I think that is the key element, right? That I think we shouldn't forget, of course, that when markets are cyclical, that when prices come down, then your LTV, of course, goes up. So we are focused on making sure that we reach a debt level where no matter what would happen in the future on markets, we'd feel comfortable with that debt level. It's also clear that we would not reduce debt levels down to zero. That's not the intention. We don't think that's a the best way of deploy capital. So we will definitely keep an element of debt around the structure. So the other thing I think to highlight out of this is in general that that we in Hafnia have a strong focus on the cost side, and we do have the lowest cost base of all of our peers when you compare both OPEX, financial expenses, and SG&A, and I think that's a cost discipline that we will continue to focus strong on, because ultimately whenever market change, it's your cost level that will allow you to be able to do things when markets are weak and actually be offensive and make strategic moves rather than be passive.
Cool. Is there anything, I guess now we're moving also a little bit ahead, so in terms of your coverage, maybe you can remind us on your coverage for Q1 and onwards, please.
Yeah. So if you look top right, you can see that we today have, for Q1 2024, we have a total coverage of 80% at a time charter equivalent rate of 37,668, which is obviously significantly higher than the average for 2023 overall. But I think what's also interesting is when you look at the right side is that for the balance of 2024, or the entire 2024, we have 30% covered at $33,400, which is actually higher than the overall annual result of around 32,000 TCE for 2023. So I think it's fair to say that we are now on the way to a 2024 that has not only started, but also when we look for the full year, is looking at higher numbers than what we saw in the past year.
Cool. And can I just remind everybody, if you have any questions to these remarks, then please put them in the chat. Thank you. This I always find a very interesting slide, because this is actually a prediction of the future if you take into account what you know today. Maybe you can walk us through this.
Yeah. So I think if you start on the left side, then we have basically taken the analyst consensus and said, on the basis of that consensus, for applying that for the rest of 2024, where would we end up in terms of result? And as you can see here, that would result in an EBITDA of $990 million and a net profit of 740, using the analyst consensus of how they see the market going forward. If we then look at the second one, you're looking at the numbers that we have already covered for Q1. If we took those numbers and extrapolated those for the rest of the year, for what we have already covered, we would end up at a net result of $960 million. So again, significantly higher than what we saw in 2023. And then finally, we're talking about the 2024 covered rates as of 29th February. So basically, if we took the rates that were covered already and put them for the rest of the year on the same level that has been covered, then it would be $850 million in net profit. So I think all in all, except for the analyst consensus, then basically, as far as all the covered rates are concerned and what we know already, we should be looking at a stronger 2024 than 2023.
Yeah, just for comparison, this is my remark, Michael. You don't have to comment on that. The full year 2023 was 800 million approximately. So that means that you have an additional 160 if you apply the middle one now, the Q1 rates. That's approximately what you're targeting here, I guess.
Correct.
Yes. Let's then dig a little bit into the situation in the market, because everybody is sort of, if I can say something from my perspective, this is about the longevity of this cycle. And of course, there's some things going on in the Red Sea and the Panama Canal, which I also would like to discuss. But and we can get back to that. So why don't we start with the Red Sea, because there's so many things and noise around this area. So maybe you can just give us some clarity, please.
Yeah, so I think when the unfortunate conflict started and the Red Sea got dragged into the conflict in Gaza, then it became very quickly clear that the risk factor for going through the Red Sea was increasing, and therefore, within a period of 4 weeks, I think most owners of tankers at least decided that it was simply not safe to send our crew and vessels through the Red Sea, and therefore the consequence has really been that today the vast majority, at least all the responsible owners in the world, will be sailing south of Cape of Good Hope instead of going through the Red Sea. And what effect that has on the market is naturally that, first and foremost, the good part is that you then know that all your crew and colleagues at sea are safe. And secondly, from a market perspective, as you can see here, it adds another 15 days roughly to the voyage, which of course means that there are fewer ships available for the next cargoes. So technically what this longer distance means is that you are putting pressure on the market in an upwards direction because there are fewer ships for the same amount of cargoes available. So it has undoubtedly already had some impact on the freight environment, but in our view, we have not seen the full impact yet. We are still, in our view, a few weeks away from seeing the really full effect of having all these ships spread out and going much longer distances than before.
Okay, and then let me, I will skip a few slides. There's many details on these slides, and please feel free to dig into them yourself. But let's just take a little bit on the demand side, because I guess that's very important that actually you expect the usage of oil worldwide and products to go up.
Yeah. So I think in general terms, I mean, we're not trying in Hafnia to second guess, if you like, the world's analysts around oil demand. So in general terms, what we do is we obviously try to analyze and understand the background of EIA, IEA, etc., all the international oil agencies' view on oil demand. And I think it's fair to say that for all of them, they have the same view that oil demand will be slowly increasing at least up until the end of this decade into 2030. So at least in the foreseeable future, we're looking at an oil demand scenario that is still relatively strong. But what's important around this is also to understand that and I'm sure you're going to get to that slide afterwards, is that it's really the supply side that's important here. But I think the demand picture
that was immediately.
Yeah, I think that the demand picture that I just described before, I think what's important to understand is we had a few years where I think a lot of people was of the view that oil demand would be falling and dropping rapidly in this whole decarbonization discussion. So a lot of people underinvested, both in production of oil, but also in the construction of new ships. So as oil demand suddenly surprised to the upside and is now showing strength, it's clear that, as we see here, we simply don't have enough vessels, in our view, to transport the demand that will be needed. And if you look at the right side of this graph, I think what's important to understand is that if you look from 2003 to 2010, this is where the absolutely majority of our current fleet was being built. And as you can see, more than 1,100 vessels will be above 20 years by 2029. And then you look right and you see how few ships that are coming in the current order book. So if you kind of hold that supply picture up against a demand that's still going up and a supply of vessels that is going down dramatically, this is really the core longevity reason why we think the product tanker market is in for a long run, and which, by the way, is the reason that we invested in 44 ships back in 2021, 2022, not because we saw, of course, any conflicts arising neither in Ukraine or in Gaza, but simply because we fundamentally could see we are entering a phase of many years where the market will be undersupplied.
So just putting a spotlight on the 13% that you have mentioned in the second bullet point here. I remember when we started the year of 24, it was approximately 9, as far as I remember. So there's been a few additions. So if you decided to buy a ship now, a vessel now, when would you actually be able to get it to the market?
So that will be in 2027.
2027.
And I think this is the big point to understand that 13%, although it's been going up a little bit, but it's divided over 4 years, right? And normally, in a normal situation, if we ordered the ship today, we would get it in 18 months. That means we would be getting it in 2025. Now we're getting it in 2027. So it's just to illustrate that the order book in percentage has to be assessed according to how many years it's spread out on. So for the time being, this is now a 4-year period, the 13%.
Yeah, and maybe an unfair question, but a lot of investors knows Maersk and the container market, and could you perhaps just reflect a little bit of the key differences between the product market and the container market as you see it?
Well, I think that one of the key differences is that obviously container markets are more a logistical trade rather than a trading trade. So in the sense that you have fixed ports and fixed rhythm of where you go. That's one part. I think secondly, the big difference is also, of course, that with container ships, it's a lot about reducing cost per unit. And the third part I would say is that in the container trade, you have a much more direct interaction with your customers. So when it comes to decarbonization, you've seen quite a lot more container ships being built that already now have renewable engines, etc. Whereas in the transportation of oil, it's very different since we are trading globally around the world and we don't have the same accessibility to new renewable products that, for instance, the container owners will have. So these are kind of some of the differences in that respect.
I guess my point for asking, Michael, is that the situation that you've seen going from bananas in containers towards a nightmare on the order cycle cannot happen within product tank.
It cannot. It's simply impossible. Even if we wanted to ruin the market and order as many ships as we could, it would be for 2027. And even looking at this slide here, as you can see, in a stable oil demand scenario, even if we took out all the yard capacity that exists and only built product tankers, no container ships, no nothing else, we would not be able to close the gap into all the ships that are becoming too old and disappearing in that period.
Yeah, and I guess a lot of this also has to do with scrapping that seems to be postponing. If you run a ship by 37,000 on average, of course you will not scrap it. Can you describe that dynamic perhaps?
Yeah, so I think that's very true. I think that obviously when markets are strong, everybody will try to extract as much value as they can out of their older ships. But I think it's also relatively clear now that this is becoming more and more difficult because regulations are more strict and environmental regulations are more strict. So it will be very, very difficult to have ships ongoing beyond 20 years that are at the same time able to live up to the environmental regulations on one side. And also on the other side, with all the extra taxes that are now coming in on emissions in general, those older ships will become very expensive for the clients compared to newer ships because basically the extra tax on top would be exorbitant. So these are some of the things that, in our view, makes it very clear that older ships will find it very difficult to trade in the next period of 4 to 5 years.
And your average fleet of 8.3 years of age, how does that compare to the rest of the industry in this regards?
Yeah, so that is compared to an industry average of between 12 and 13 years in general. So you can say that in that context, we do have one of the most modern fleets around.
Okay, cool. I guess this is just to briefly touch upon the ESG aspects of shipping. We all know that there is, substantial things that can be done within the shipping area. Maybe you can just describe very briefly the Hafnia targets within ESG.
Yeah. So I think it's clear for Hafnia. Most of the things that we do, we actually do them because they make business sense. So we don't do them because we are necessarily looking to get medals and other things. We're trying to do them because it makes sense for Hafnia as a business. And dual fuel vessels, for instance, of which we have just taken delivery of 4, and there will be another 4 coming, are all vessels that can burn LNG or methanol and even be retrofitted to burn clean ammonia in the future, but they're all been constructed against long-term contracts. So in other words, we have not bought any new ships in the expectation that we will be making money in a spot market or from any other savings. We have contracted them against fixed earnings going forward. And that's probably the way that we will keep on approaching this, is that until we have a very clear feeling that there is availability of clean fuels also for our ships, we will make sure that we don't take unnecessary risk, but just continue to invest with our clients, and slowly but surely we'll be going down the path of decarbonization together.
Perfect. And with that, Michael, I think we'll conclude this part and go into some of the questions, if I may.
Yep.
And they are. There's. Let me start from the beginning. There's a question on, as a shareholder in Hafnia, it would be good to know if there's any clouds on the horizon within the next 2 years, basically.
So I think, obviously it's very difficult for us to predict about geopolitical issues other than in most cases, if they create inefficiency for transportation, it's good for freight rates. But I would say that we don't see any clouds in the horizon as far as fundamentals in the product tanker industry is concerned. Because we've already just talked about it. The supply side is what it is. We are into 2027 before we can do any, if you like, further damage to the order book, and that's already way out. So no, we don't see, with things we know today, we don't see any major clouds. So if anything should happen, and people ask me often, what's your biggest concern? I think it's if there is any form of geopolitical event that in a way puts a lock on the global trade. So say, for instance, an event that would involve a lot of sanctions against China, blocking of trades globally, that type of global event would be damaging. But other than that, we don't see any clouds, sector specific, no.
Then let me follow up on your LTV again. I guess the reasoning for asking these questions is the dividend policy is very linked to the LTVs. So are you looking to do anything else than returning in the dividend form? Would you also consider buybacks of shares?
Yes, we would consider buybacks also, and we actually do debate that every quarter with the board as well. So there's been various reasons why we felt that paying dividends was better than buying back shares, but it is definitely part of the discussion every quarter with the board. What is the best alternative in terms of providing increased shareholder return?
Then some very specific questions on the refinery dislocation. That it seems to be keep increasing the ton-mile effect. Can you comment on that?
Yes, I think that is right, and so we are basically seeing that effect that we've seen over the last 10 years continuing. In particular, we have refineries in the Middle East that came up on stream last year that have slowly but surely been going from 15, 20, 25 to 30, 35% in production. So those refineries are export oriented out of the Middle East. So we do see that those refineries will continue to add more ton mile as they start increasing production of refined products and continue to push the products out in the market. But in general terms, the trend is the same. Refinery closures in the US, in Europe, is being replaced by refinery built in the Middle East, Southeast Asia, and Far East. And that's a trend that we've seen for a long time, and why you're also seeing products traveling further from, amongst others, east to west.
Then a question on different product tanker categories, if there's anything in particular you want to highlight. And I guess the question goes on the LRs, the MRs, the handies, and the chemical. Are there anything in particular you can comment on here? Any particular strength or any particular weaknesses? I guess the question is.
Yeah. So I think what's important to understand overall is that the product tanker market is really one market. So in other words, that you're never going to have one sector that outperforms all the others, because in that case, either cargoes are going to get chopped up to smaller quantities and use smaller ships, and vice versa. So we kind of move in a little bit in synchron. But I think it's fair to say that when we look at investments in general around the world, there are always more investments in the medium range market because it's the most liquid. So if somebody wants to be an asset player, you would see them often go into the medium MR market because that's where you can get in and out quicker. But technically for us, we have been focusing quite a lot on MRs, LR1s, and also LR2s. That's kind of been the main focus for our investments over the last few years.
And then a final question on the future availability of green fuels.
Yeah.
It's a very complicated issue, but maybe you can make a general statement on your position within green fuels.
So I think our position is that we are not going to gamble on guessing on what will be the winning greener fuels in the future. What we're going to try to focus on at the moment is to make sure that our current asset base improves all the time. For the greener fuel, it's something that will happen, in our view, probably later and not sooner. We think there's a big challenge in the sense of having sufficient production that we have to remember, these are not only fuels for the shipping industry. These are fuels that will be used for a lot of different purposes before they probably reach the shipping industry. So our focus is actually a lot more now about making sure that we have a constant modern fleet, and that we are able to, for instance, work with biofuels and other drop-in to continue to bring down the environmental footprint. And then we'll have to monitor slowly but surely how the development of the greener fuels will be in the future.
Wonderful. Thank you everybody for participating in this event. Thank you to you, Michael, for participating. And if you have any questions, please look at the Hafnia webpage or inderes.dk, then you can find most information. Thank you very much for participating.